Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that just remains in this super aggressive downtrend. We've had very little relief from the downtrend. It's been very aggressive, much more aggressive than even the top of the 2008 financial crisis, where in order to reach 23% drop from the high, the market actually took 280 trading days before that happened. In 2022, we've seen that occur in just 160 days. So very, very quick, very little relief. So in this video, we're going to go back in history and compare some of the signals that we've had today to some of the technical developments that we actually saw throughout the 1970s right here, a period that had some of the largest swings in volatility, both up and down, between around 1966 right here all the way to 1982. Just a huge period of uncertainty, lots of volatility, extremely uncertain market conditions. And we're going to go back, see if some things look similar to today and what kind of conclusions we can draw from that. If you are interested in following these crazy markets with us, make sure to smash that subscribe button. Also, make sure to click on that like button. If you enjoy this video, if you appreciate the effort and the time that goes into making these types of videos. And now, without further ado, let's get right into it. All right, so I want to discuss a very important signal. Let me jump over to the daily chart. A signal that occurred right here and that left me a little bit puzzled. On this rally here from the May low all the way to the June high here, this was a very, very powerful, strong rally that had just a huge amount of participation. And we actually saw the McClellan oscillator flash a signal on that day during that big rally. Now, what's the McClellan oscillator? It's essentially a measure of the market breadth and the momentum of the market breadth. And you can see it. It's highly efficient at predicting moves in the market. Let me zoom in on this period here. Zoom into the 5-year. You can see strong recoveries on the McClellan oscillator here from a low reading to a high reading. That doesn't happen very often, right? Most of the time, the McClellan oscillator will trade between the red and the green line here, but sometimes you'll get these massive spikes to the upside, and that often corresponds to some pretty interesting buy readings. We had one in 2018 here after this 20% drop in the market. The very beginning of the next rally started with this reading on the McClellan oscillator. Same thing on the recovery from COVID. Big reading on this oscillator. If we zoom out further, you can see it also happened in 2016. If we go back to the 1980s here, you can see you had a handful of readings in 1984, in 1982 right here. These corresponded to the beginning of major rallies in the market. Let's go back a little bit further right here again in 1975 again here. But if we take a look at 2022, look at what happened here. Huge fail, huge whipsaw signal where you had this big participation rally and then the stock market failed to follow through on that move. So what does that mean? Can we take a look at previous examples where we've seen that type of behavior? And one of the readings that stood out to me was actually 1973 right here. Now in this scenario, we were right here in 1973. Let's take a look at where stocks were from the high here, relentless move down. We were around 24% down from the all-time high, very similar to today. This was an environment where inflation was soaring. Inflation rate was soaring here and bringing down the market. This was the primary reason why the market was moving down. If we take a look at what was happening to yields, this is the 1-year Treasury yield. I can also put the 10-year Treasury yield. You can see yields were moving up very aggressively throughout this period as with inflation. You can see the blue and yellow line are yields moving higher with inflation. You know, these are tough market conditions for the stock market that was moving down here. Right, so let's fast forward to 2022 and see how similar that market environment is. You've got a market that's been going down with inflation that's been soaring and yields that have been soaring along with that. bringing the market lower. So evidently, we have very similar macro situations to 1973. We have a signal on the McClellan oscillator that was triggered in 1973 and that led to another steep capitulation in the stock market that happened in 2022. So is that something we should be concerned about today in 2022? Is that something that we should be open to thinking about as a real possibility? So I want to compare this reading here that we got in May. So the May 2022 situation where we got that failed reading to the 1973 reading right here in December 1973, where you had that same reading. And we can quickly compare the macro conditions back then and see if we should be worried about the same type of capitulation here. And that was actually another 40% drop from that reading. If we fast forward to today, what would that look like in today's market from that reading? 40% drop from that reading would actually take us all the way down near the COVID lows right here. So that would be a very, very scary type of development, and definitely the type of market environment we want to be out of. So if the conclusion from this video is that we're in an incredibly similar spot to December 1973 today, we want to adopt a very bearish tone here. And I'm going to take a look at this from two different angles. The first one is going to be inflation, and the second one is going to be unemployment. Because here what the market is pricing in is essentially a recession. And this is something we discussed in one of our recent videos. This is the year-over-year change of the S&P 500 compared to the manufacturing PMI, which is a good economic indicator. Now you can see what's been happening here. We've had this massive move down in the stock market, but that's happening ahead of PMIs, right? PMIs don't look like they did back in 2009. So this is the market anticipating that we're going into a recession. And it's interesting because back in 1973, you actually had a very similar setup where you also had the market move down here, that black line ahead of the economic activity, which was still elevated. So in this case, the market was right, saying there's a recession coming. The recession came and the market went down even further from that moment. So one of the things we can take a look at is unemployment to compare if we're seeing that same setup today, that we're about to enter recession here with a massive decline in economic activity. So let me add the unemployment rate here. And you can see here throughout the last couple of years, we've had the unemployment rate move down exponentially. We're very low. We're at the same levels that we were at before the pandemic, and we have not yet seen signs of this moving higher, at least not for now. If we go back to 1973 to that reading that we had in December, January right here, you can see what was happening to the unemployment rate leading up to that reading. It was moving higher in a big way. So I think that's a difference to note. I think here you clearly had this rollover in unemployment that told you, okay, yeah, this is the moment here. Unemployment is starting to rise, and we could definitely be in a recession in the very near future. And in fact, that recession materialized and unemployment really went higher. And in fact, we can take a look at what that looks like on the PMI. PMIs collapsed here along with this skyrocket in unemployment. So the market was very right about a recession here. Here, the market is also anticipating a recession, but we haven't seen the unemployment rise yet, right? So that's a big difference here, and definitely something to note. You can still believe you're heading into a recession, but to us, it seems like a different setup when it comes to the dynamics we're seeing in the employment market. And to see a recession, one of the biggest characteristics of a recession is rising unemployment. You see that every time in real recession bear markets, you see the unemployment rate rise as the market is going down. Now, sometimes the market can anticipate that, like it did in 1973, and perhaps it's going to be right about that happening today, but there's still definitely a lot of work to do before that materializes. Now, the second big component that I want to compare is inflation. Now, inflation has clearly been driving down the market, As yields have been rising, valuations have been compressing and pushing down stocks. And that was exactly the same dynamic that we had back in 1973, where inflation here, let me put up the inflation rate. Inflation was skyrocketing throughout this entire move down in the market. And so let's take a look at where inflation was here back in December 1973. We were still in the very heat of the inflation momentum here. In fact, in the months that followed, you can see here between that moment and the inflation peak, it took a full year before inflation peaked. Now, perhaps that's something we're going to see today. Perhaps we're going to look back to this day and we're going to see that inflation continued to climb until May 2023. Now, in our opinion, the number one thing that we can use to determine whether or not inflation is about to peak or whether it's going to continue surging, it's oil. So let me quickly take a look at the price of oil here in 73. And you can see here, this was the very heat of the oil shock here. Massive surge in oil prices, which contributed to elevated inflation rates in the months ahead. From the moment that you had this spike in oil prices in December 1973 right here, you knew that year-on-year inflation was not going to be peaking until around December 1974 at the very least. Guess where December 1974 was? Right here. Guess where inflation peaked? Right here in December 1974. Now, if we take a look at oil prices today, we're still very elevated. We obviously had this massive run throughout 2022, but it seems like perhaps we're starting to get a move down on oil here. If we jump to a weekly chart, the momentum is starting to turn bearish here. And from the research that we've over the past couple of months, it seems like oil has a lot less space to contribute to CPI. It's very, very overextended in terms of how much it's contributing to CPI. There's a lot more downside risk than upside potential for oil to continue moving higher. So just at a glance, the macro setup that we have today is definitely different to what we had in 1973. When that failed reading occurred, you had rising unemployment leading up to that reading, and you just had oil move up from $4 all the way to $10 almost overnight in this period. Whereas today, most of the larger part of the move up in oil, where oil prices moved up 200%, that's very much in the rearview mirror. Now, we did have some extra volatility here, and that's added to that uncertainty and likely contributed to additional downside in the market. But most of the oil inflation is in the rearview mirror. So although we could be absolutely wrong on this, it doesn't seem like we should be expecting this type of collapse in the market imminently. And the more evidence we get that oil is cooling down, energy prices are moving down, there's natural gas that is also moving down pretty aggressively over the past couple of weeks here. The commodity index is moving down here. So the more we get follow through on these moves, the more likely it is that disinflation is going to materialize and we're not going to be getting a big collapse in the market. Now, we cover all this in a lot of detail on our website at gameoftrades.net. We recently posted an article on the technology sector and whether or not these stocks are overvalued like they were back in the 90s, and whether they're presenting bubble-like characteristics, whether we should stay away from the technology sector, or if this is going to be one of the big outperformers coming out of this correction, because choosing the outperformer coming off a bottom can lead to tremendous returns. And this is why we're not excessively worried about being early on a market recovery, because recoveries off lows can be absolutely monstrous. They can be very rapid. And if you wait for that true bottom to occur, it often doesn't leave you a chance to get back into the market before we've seen that massive recovery. So don't hesitate to take a look at these pieces, take a look at this research, these updates, where we take a look at what's going on in the market and whether or not certain setups are materializing. And we're also currently working on the model portfolio, where we're going to put all of these ideas, all of these sectors and assets that we think are going to be outperforming. We're going to put them into a strategic model portfolio, which is hopefully going to be a major addition to the service. If you're interested in having access to all of this, make sure to click on the link down below and go to gameoftrades.net to join our growing community of individual investors seeking to stay ahead of what's going on in the market. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. Don't forget to click on that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.